Something happened in the last 48 hours that most Americans have completely missed, and it could change the entire structure of the silver market. Not a chart pattern, not a Reddit squeeze, not a rumor. A government policy announcement, a public SEC filing from a major mining company, a dealer letter confirming supply strain, and a futures market setup that has 9 days before it potentially collides with physical reality. 4 separate signals. 4 different sources. 1 conclusion. Almost no one in mainstream financial media is connecting them. Today is Wednesday, February 18, 2026. Silver is trading at 70 CVN 15, up nearly 5% today and more than 20% off the recent crash low of $63.90. Most investors are focused on the bounce. They're watching the price and thinking the story is about volatility. But the real story isn't the bounce, it's the structure underneath it. At a recent critical minerals meeting hosted by the U.S. State Department, Vice President J.D. Vance announced that the United States is developing a reference pricing system, effectively a price floor, for critical minerals. Silver is included in that framework. In simple terms, the U.S. government looked at current silver prices and determined they are strategically too low. This isn't about speculation. Silver is embedded in missile systems, radar arrays, semiconductors, solar infrastructure, and advanced defense electronics. When the executive branch publicly signals that a metal is strategically underpriced and begins constructing policy tools around it, that's not market commentary. That's structural change. At the same time, Hecla Mining, the largest primary silver producer in North America, filed quarterly results showing something remarkable. While the average benchmark silver price during Q4 2025 was $54.83, the company's realized selling price was $69.28, nearly 30% higher than the quoted exchange price. That means industrial buyers were paying a significant premium for guaranteed physical supply. Exchange prices said one thing, real-world transactions said another. Hecla reported its strongest financial year in 135 years. Revenue surged, net income multiplied, debt was cut dramatically, and every mine generated free cash flow. Instead of diversifying, management doubled down on silver exposure and even moved to divest gold assets, despite gold trading above $5,000. Companies don't allocate capital that aggressively unless they see a powerful shift coming. Meanwhile, the largest online precious metals retailer in the United States, COMEX, confirmed that during January's surge in demand, shipping timelines were extended, product offerings were reduced, and order volumes spiked to 7 times normal levels. The only reason operations normalized was because silver crashed nearly 47% in just 8 sessions, temporarily cooling demand. Demand wasn't solved, it was suppressed by price. Now, silver has rebounded more than 20% in less than 2 weeks, and the underlying supply deficit hasn't changed. Then there's the futures market. COMEX registered silver inventory sits near 92 million ounces. March open interest is roughly 285 million ounces. Tens of thousands of in-the-money call options represent significant potential delivery exposure, and first notice day is just days away. For the market to avoid stress, contracts would need to roll forward aggressively. Current roll pace suggests that adjustment may not happen smoothly. This doesn't guarantee a crisis, but it does highlight how tight the relationship between paper contracts and physical inventory has become. Zooming out, major institutional investors like Ray Dalio have recently emphasized that hard assets are becoming essential hedges in an environment of rising debt levels and geopolitical tension. Mining equities currently represent a historically small share of global equity allocation compared to long-term averages, even as governments move to secure mineral supply chains. Silver is no longer just a commodity story. It's increasingly tied to national security, industrial policy, energy transition, and global capital allocation shifts. Between now and the next futures deadline, volatility is likely. Beyond that, if a formal pricing framework is implemented, incentives across the market change. Miners invest with downside protection. Industrial buyers lock in long-term supply. Short sellers face new structural risks. Institutional capital reassesses exposure to hard assets. None of this means silver moves in a straight line. Markets never do. But when government policy, industrial premiums, physical supply strain, and derivatives positioning all align at the same time, it deserves attention. If you hold physical silver, understand that you're holding an asset increasingly viewed as strategic infrastructure. If you hold paper instruments, understand the structure behind them. And if you're watching from the sidelines, consider how often governments publicly declare a commodity underpriced and then reverse course quietly. The story isn't just about today's price, it's about the architecture forming underneath it.